This is the fifth of 5 recordings for Chapter 11. So, presentation and analysis. You are supposed to show the depreciation expense for the period on the income statement. The balance sheet should have the major classes of depreciable assets grouped together by nature and function. You should be reflecting the accumulated depreciation on the assets. And in your footnotes, you need to give a general description of the method or the methods used in computing depreciation. Analysis, we have some things we can look at to see how the company is performing. So an asset turnover ratio tells you the company's ability to use their assets to generate sales. Profit margin tells you how much of each dollar of sales ends up being profit. Rate of return on assets tells you the return earned on the assets in place. So are they successful in using their assets? One of the things that often will be looked at is this disaggregation of return on assets. So you can take return on assets and express it as the profit margin times the asset turnover, because these things cancel out, and so you still have the same equation, but it allows you to determine if it's the asset turnover that has increased to make your rate of return go up, or the profit margin that's gone up, so you can better understand what's driving the changes. Okay. Makers is a tax method of depreciation, and I won't test you on this, but you do need to know it exists. So it does do accelerated cost recovery. There is no salvage value for this. It's going to be applying a tax life that is mandated by the IRS for different classifications of assets. And usually those are shorter than the economic life, so you're going to accelerate the depreciation of the asset. So here is the list of the different recovery periods they use. So, for example, residential rental property, usually you assume 40 years for a building, and this uses 27 and a half. So you can see it's accelerated. It's going to say it lasts less time. You have to accelerate it over a shorter time period. Here was just an example. You can take a look at this. This is expressing it as percentage rates. And you will keep 2 sets of books. You can't use makers for your financial reporting. So you will have to have a tax set of books that will have the makers depreciation, and you will have a financial reporting set of books that will have the GAAP approved depreciation method. You can apply straight line to the classes of property described under makers. Again, that would not have any salvage values, and it's going to result in an accelerated depreciation. So here's where I was talking about you have to have 2 sets of books, financial and tax. IFRS, property, plant, and equipment definition is pretty much the same. Depreciation methods are pretty much the same. They have the same ones available. Plant asset disposals is the same under GAAP and IFRS. Accounting for initial costs for natural resources is the same under GAAP and IFRS. Capitalization of interest costs are the same, except for under IFRS you can net interest revenue that from borrowings specific to the construction against the interest expense. Non-monetary exchanges are now similar between the two, and same depreciation methods across the two. IFRS requires component depreciation. Under GAAP, you can use it, but it isn't usually used. IFRS, they use either a historical cost model, so that's what we're doing, or they do a revaluation model, which is fair value method, basically. GAAP doesn't let you do revaluation. And when you test the impairment for long-term assets, GAAP uses the two-step method. IFRS is more strict. It's going to have you use a lower cash flow thing, so you're more likely to have an impairment under IFRS. And under IFRS, you can reverse the impairment. However, GAAP doesn't let you do that.